All right. We are live. It is Wednesday, October 26th, and apologize for not making it on Monday. I was feeling a little bit under the weather, but I'm back in action. Got some sleep, got some coffee in me, and I'm feeling good. This week has been an interesting one in mortgage. Got a couple different things to talk about. One, a couple announcements from the FHFA. Sandra Thompson, their director, talked about two different things this week. One being the new credit scoring models that they plan to use, how that's going to affect homeowners and who can qualify and who can't. All the talk is around 72,000 more people are going to qualify. Certain demographics are going to see an uptick of 16, 17% in who qualifies because these new models are going to take into account rent payments, utility payments, and things like that. Another big announcement from them is that loan level price adjustments, which for all intents and purposes, just call that the price of the loan, the rate of the loan, is going to get better for first-time home buyers, anybody who qualifies for Home Ready or Home Possible. Got videos on that you can look into, Home Ready or Home Possible, how to qualify. But low to moderate income folks, generally considered less than 100% of the area median income. There's plenty of lookup tools online where you can find what your area median income, wherever you live, is. Those loan level price adjustments going away means, a real simple way of looking at it, the loans are going to be cheaper. If it cost $3,000 for a 6.5%, with the loan level price adjustments being erased on those loans for those borrowers, you can now get that same 6.5% for zero cost, or you can get a 6.375 with zero cost. These are just examples, right? But just to give you an idea, just know that it's going to make home ownership more accessible for low to moderate income buyers. If you're a first-time buyer and you're under 100% AMI, that's definitely going to be the case. In some areas, it's going to be under 120% of the AMI. In some higher cost areas, Home Possible, Home Ready, those folks that qualify for that, that's better pricing, lower mortgage insurance, less cost, more access. And one of the areas where they're going to take and make it more expensive is cash out refinance. So it's like, hey, if somebody really feels the need to do a cash out refinance, they have a bunch of equity, we're going to charge them a little bit more. First-time home buyers, low to moderate income, we're going to give some to them. That's what came out of FHFA in regards to that. And I'll give you a little bit of information. I made a video on it, didn't go into a ton of detail because we really don't know exactly how it's going to roll out. We know that this FICO 10T is something that's not brand new. It's been around since I think 2020, but FHFA approved two scoring models, that FICO 10T and Vantage Score 4.0, instead of using classic FICO models. And the goal is that it's going to be more accurate depiction of how somebody handles credit. It's going to take into account full payment histories and rent payments, utilities, telephone payments. And so the goal of this is that more people are going to qualify. I think that an unintended consequence, and I talked about this in a little bit of detail with my buddy Mike Zuber this morning, is that it's not going to help everybody. The T in FICO 10T actually stands for trended. And what they mean by trended is that they're going to look back over the last 24 months and see how you treated your relationship with credit, right? Did you keep high balances? Were your balances close to what the max allowable or credit limits you had was? And did you pay them off every month? Things like that. Because what can happen currently is that somebody can freshen up their credit, get really pretty right before the picture's taken, which is the credit report, right? And a credit report currently is like a snapshot in time. Right now, we pull your credit, you've got $1,100 balance on Home Depot, a $1,500 balance on Nordstrom, and a car payment, right? That's all that's really taken into account. It doesn't take into account what was the balance last month, what was the month before, what was the month before. 18 months ago, Did you have 4,400 in debt payments versus 5,000 in total available credit? And then as soon as your available credit went to 10,000, you charged it up to 9,000. Those are the type of things that, in my opinion, might pull some people's score down. Why am I doing all these hand gestures today? What is going on with me? I'm just feeling better. So that's a change. And something else I heard is that rather than having to use 3 credit bureaus, like we've always done in mortgage, TransUnion, Equifax, and Experian, they're only going to require that lenders use 2 of the 3 agencies. So we don't know when that's implemented. We don't know if it's, Q1 of next year, Q4 of next year, 2024. We'll wait and see. But nonetheless, I think another good thing I'm hearing about these models is we're getting away from FICO having complete control of it, right? Where like classic FICO has been the scoring model for 2 decades. They've been the only player in town. Now we got some new players in town. So that should do nothing but help. So new scoring models, better pricing for low to moderate income buyers, home ready, home possible. This probably takes effect in the next month or 2. More expensive cash out refinances. Another thing that's not necessarily been implemented or been announced, but I hear rumblings because I keep my ear close to the street in mortgage. More down payment assistance programs, more programs designed to help people that quite honestly weren't able to buy or in a position to buy over the last couple of years or really anytime, right? So I know specifically on the broker side of things, we've got our biggest organization AIM, which is Independent Mortgage Experts, Association of Independent Mortgage Experts. They're doing a bunch of lobbying on behalf of brokers, a bunch of great stuff in the broker community. One of those things is some of these retail lenders, some of these banks have access to down payment assistance programs where, we may be limited. We're slowly but surely gaining access to more and more of those. Hometown Heroes is one of them in Florida that we're going to have access to in the next 30 days. We've already got a nationwide program with EPM's Empower down payment assistance program. All the state programs, but I think more of that stuff is coming where it's going to be assistance with down payment. It's going to be making the entry-level loans more affordable. Those are the people that need the help more than ever. And you can read through the lines on any of the stuff that comes out from the FHFA or anyone else. If you were perfect credit score, W-2 income of 300 grand, and everything was the wind was at your back, you refinanced into 2.5% conventional loan, and you got the very best of the loan terms. Shouldn't be the only one that has access to the best mortgages, right? Obviously, risk plays a part. And so somebody who comes to me and says, hey, I got a 585 credit score, I should get the same mortgage as that person over there. Not necessarily, right? But access shouldn't be limited to only those to only certain groups. That's all I'm going to say about that. Okay. Off that soapbox, onto a new soapbox. Joey Garessi, how you doing, my man? I'm still getting over this cough, but I'm back, bro. I appreciate your support. Thanks for being here. Yeah, if I said make mortgages great again or make them great AF, I might get in trouble. I stay out of politics. Truth be told, I'm in the middle anyway, right? And so I'm helping people of all political parties, of all races, of all genders, everybody with home ownership. I'm not discriminating and I'm not politicking anyway, right? Because I think that everybody deserves access to home ownership. I'm a big proponent of real estate for building wealth, stability for families, for all the reasons I love mortgage. So you'll never catch me politicking for sure. So anything new with construction loans for first-time home buyers. Flow right at 55. I'd love for you to expand on this because I think I've got a pretty good finger on the pulse. I talk to people all day, every day. And when you say construction loans for first-time home buyers, I don't know. I don't necessarily think you're talking about buying a new construction home. I think you're talking about like, hey, I'm a first-time home buyer. I want to go build a house. And as much as that sounds great, it's really not feasible. And people have come to me too, and they're like, I've got $9,400. How do I buy a plot of land and then build a $300,000 house on it? One, the land loans require 30 to 40% down, and land in a lot of areas is not cheap, right? You buy a lot in a decent neighborhood in Sacramento, and it costs you $200,000 just for the lot. And then, building a house and getting a construction loan, they want you to have skin in the game. So really, it's a game that's only played by people who are really in a good position when it comes to capital. And even then, people think home prices are high with the red tape around construction and construction costs right now. Like, you can't build it any cheaper, even if you wanted to. So that's me making a lot of assumptions. If your question's different, feel free to let me know. But that was just an assumption-based answer based on questions I get from some people sometimes, like, houses are unaffordable. I'm gonna go build one. And I tell them, well, not necessarily gonna be the best route. Joe the broker, what a political answer. Well, maybe I'm practicing. Maybe I'm going for governor of California. What do you say? You vote for me, Joe? Okay, podcast giveaway. We've got to mention this. Whenever I share my screen, it messes up my video quality. So I don't think I'm necessarily going to share my screen, but I shared the link in the comments. And let me see if this is it. If you subscribe to the Get Better Everyday podcast and go and fill out this form, I'm telling you, there's less than 100 people, and we're going to draw somebody. I'm going to take entries through the end of tomorrow. I think it's a great podcast. If you're in the mortgage space and you're watching this, Friday, my interview with Matt Ishbia goes live. I'm interviewing the best of the best. And quite honestly, I'm not interviewing just high-level executives like Matt Ishbia. I'm interviewing friends that run rehab centers. I'm interviewing entrepreneurs. I'm interviewing people that I just look to for inspiration, because I think we all need some of that, right? And we're all trying to get better every day, whether we're doing that and when we're taking our very first steps after not necessarily making the right choices in life, or whether you're, Matt Ishbia, who's grown a $13 billion company over the last 19 years. Whatever the case, like, get better every day, passion project. I'm really excited about it. I've had some really cool guests. I've got like the coolest lineup of people that have already told me they're going to be on it. I'm going to be interviewing UFC fighters, NBA players, all kinds of cool folks, right? Because hopefully, like me, you're trying to get better every day. And when somebody asks me how I'm doing better than yesterday, but not as good as I'll be doing tomorrow. So anyhow, link is in there for that contest. I think I've got a link to the podcast, which I can put up as well. It's on Apple and Spotify. I'm actually putting all the videos up on YouTube. Oh, we got 26 reviews. What's up? Go to the Get Better Everyday podcast and leave me a review. Listen to a podcast so that it's a real review. Get inspired and then leave a review. But I'd appreciate the heck out of it. The more people watch it, leave reviews, and help me share it and promote it, the more I'm going to be able to inspire one person, right? I talk about this a lot with people. I love mortgage. I love real estate. I love helping people build wealth. And this can be life-changing for people and families. I think that I can have even more impact if I reach somebody who's struggling, somebody who, relapsed on drugs, somebody who is down on their luck and thinking they don't want to be around anymore. If somebody like that gets inspired and turns their life around, that's a big of a win. as somebody who's the first person ever in their family to buy a house, and they go on to create generational wealth and pass that on to others. So couple ways I'm trying to have an impact on this world we're all standing on, floating around in. Get Better Everyday podcast and the mortgage thing. So do that. I'd appreciate it. If not, all good. Ask whatever questions you got. This is a question that I'm actually going to pose on YouTube for all 18,000 subscribers. Who are you? Real estate agent, fellow loan officer, home buyer, investor, entrepreneur, someone who just likes to keep up on mortgage and happens to think that I shoot straight. Whatever the case may be, I'd love to hear who the audience is, mainly so that I can tailor my message and my videos and the things that I'm doing to you. Part of me wants to do some real estate mortgage coaching. And if 70% of my audience is loan originators, it makes sense. If 75% of my audience is the end consumer, and I start talking about, how to do mortgage brokering better, might not be a hit. So I got to know who you is. Let me know. All right, let's see. The Riley Oak. I locked in 2.8 watching me and Mike Zuber. If anybody doesn't know, Mike Zuber, one rental at a time. I've probably got a library of 150 videos on his channel because we go live every Wednesday. We don't go live. I guess he records them and posts them, but great dude who's a real estate investor in California, has 180 personal units, just got into contract on another one, leading by example, showing people there's deals to be had, literally bought a deal off of the MLS. And he's got experts across the real estate industry that he interviews every single day. And he puts out daily content around real estate, mortgage, financial markets, the economy, all that good stuff. And so it's a really, really cool channel. Go check out One Rental at a Time, my buddy Mike Zuber. And I'm glad, thanks for sharing that. The Riley Oak 2.8, man, must have been like January or something. So congrats to you for locking in that 2.8. I've got 6 mortgages and they're just sweet getting that statement in the mail every month. I think we'll stabilize and we'll get back around 5% sometime next year, but that was maybe a once in a lifetime opportunity for all the people that locked in rates at 2.5, 2.625, 2.875. All right. Jared Haxton. Hey, Matt, do you know how it looks if I bought a $500K house, but the seller carried $200K of it? What does a lender think about that? I've actually got a question out to a couple of my conventional lenders about it because I don't think you can carry a conventional first, in your case, like a 60% first and that 40% second, if it's not from, if it's a personal person carrying that second. I know that there's lenders that will do it on the non-QM side. I'm going to confirm because I feel like I shot that question out in the space and I don't know if I heard back. I don't know if I followed up on it, but let me know if the sound or the video starts funking up because I'm going to share my screen and I don't know how it affects it. I think it might make the audio quality worse or the video quality worse. I think it does for whatever reason. I got to fix that, but these are some slides that I used on a video I made today, but I think they're interesting to look at, what mortgage rates do during a recession. Some of us will say we're already in a recession, and some of us will know that we're going into one. What's the latest stat? 99% chance we're headed into a recession. And here's the last 6 recessions: 80, 81, 82, 90s, 2000s, Great Recession, COVID-19 recession. Rates went down by 4.25%, went down by 5%, went down by 3.25%, went down by about, what's that? 5/8, 1.125, and then 1%. So 6 for 6 on mortgage rates going down over the last 6 recessions. Here's another one that, recession doesn't equal a housing crisis, where over these last 6 recessions, there was one that housing got annihilated, and we all know that one, 2008. And it's no surprise to me or anybody who was around, when anybody can get a loan for any amount, and appraisers will appraise a house for any amount, and there's no, funky audio. Gosh darn it. All right, let me know if audio's back. I got to get with StreamYard, because that's disappointing that I can't share my screen. Audio restored. All right, hopefully audio is restored. Another thing I showed on the video I made today was the home prices forecasted for 2023. I just won't share my screen. It sucks, but we'll ask StreamYard why the heck we're paying them every month if it's going to be choppy every time I try to share my screen. I think that's what happened in my last long form YouTube video too. Somebody said it was crappy resolution. It was because of this, but I'd love to hear your guys' comments on what you think in 2023. Because quite honestly, me, the average person, Goldman Sachs, Wells Fargo, we're all guessing, right? So, gosh darn it. All right. Are we back? I closed all windows. It's just me. If it's still choppy, either StreamYard's got a problem, my internet's got a problem, internet access. It's showing all my bars. Now I'm really going to mess it up. We should be good. Let me know if it's choppy. Sounds like it's back. Okay, we're back. Who knows what that is, right? Technology's hard. I can't do too much in this office. I'm moving offices in about 5 weeks, so I'll be in the new and improved Math and Mortgage Guy studio. But anyhow, I was going to get feedback from anybody and everybody who wanted to chime in. And if you're watching this on the replay, I'd love to hear your thoughts too, because 1,000 people will watch this, after, what your forecast is for 2023. I don't care what side you're on. I don't care if you think it's going to fall 50%. The dreamers that say it's going to go up 30%, they're equally out of their mind, right? It's just not going to happen with the state of demand. If mortgage rates go down to 5%, we will see an increase in demand, and there's a chance that we see 5 to 10% appreciation next year. I don't think rates will be down that fast, and I don't think that that's necessarily something that should be expected. But anyhow, I've got a graphic, which I'm not going to show because it's going to screw up my audio, Home prices 2023, Goldman Sachs, -5 to 10%. Wells Fargo, -5.5%. Moody's, -5% to 10%. Morgan Stanley, -3%. So all four of these big financial institutions predicting home price decreases in 2023. Nothing huge, but still a decrease, which I think is probably pretty accurate, considering the fact that even though we have short supply, we have really, really quelled demand. And the silver lining I see in this is that while a bunch of people who are looking to buy and occupy are sidelined and not interested in paying 6.75%, even if there's, seller buy down, even if there's the opportunity to do it to 2-1 buy down where you kind of graduate the rate from 4.5 to 5.5 to 6.5. Investors are out there in droves getting smoking deals. Now that I'm nationwide, I've got Florida in contract, Tennessee in contract, Pennsylvania, Idaho. I think I've got contracts in 5 or 6 different states just the first 2 days of this week. And they're great deals. And when I talk to the buyers who are clients of ours, and I say, man, I don't necessarily know that market. What can you tell me about what a $190,000 house would rent for? 190 grand, purchase, 25% down. The house is going to rent for $1,400, $1,500. A long-term rental, the thing's going to get a great yield. We got clients who are doing short-term and medium-term rentals. That's going to get an even better yield. But even if they had to just put someone in there on 12-month lease, the thing's still going to cash flow. So I know there's deals to be had because I literally have clients doing it every single day. And I think the interesting part about some of these prices is like, oh, we'll see a 5-10% decline in the next year. Sellers who are really motivated to sell are going to give you the discount today. Like, you don't have to wait for it to go from, a 5% discount is $400 to $380. And so if the average price in this neighborhood is $400 and something's listed for $425 and then it sits and then it goes to $410, whatever the case may be, you can get that deal today. It's not like if you wait 3 months, 6 months, 9 months, that thing's going to be $320,000. I just don't see that happening. So anyhow, enough of that talk. Let's get into some of these questions. Bradley Coleman. Hey, Matt, hope you've been well. Any advice for a 1 to 2 deal a month guy that got destroyed the last few months? A game plan and staying positive would be great advice. I'm happy to jump on a call, Bradley. Shoot me a message on any of my socials. If you just ping me, I'll send you a calendar link for a 15-minute call. I'd love to inject some positivity into you because I can guarantee you that if you're working hard in the next 12 to 15 months, no matter what it results in, because if we go from 4.6 trillion in originations to 2 trillion or 7 million, home purchases down to 3.8 million, whatever those numbers are, one, there's still deals to be had. Two, the fact that it's harder, the fact that you have to show up and be better to get every single deal is a good thing. The loan officer that you become for 2024, the loan officer that you have to become in order to survive the next 12 to 15 months is one that's going to thrive in 24, 25, and 26. I get super inspired by things being hard. And I think that most of the team at U Mortgage feels the same way, that it's a blessing that things are as quote unquote tough as they are, right? I understand how competitive of a market it is when great clients of ours are being pulled in 4 different directions. And sometimes a builder who's fast talking and their lender says, well, we've got a 1 package close where it's the same Lennar Homes on the real estate contract and Lennar Mortgage on the mortgage. They give my client a worse deal and they work with them because they're fast talking and it's a tough market where everyone's fighting for deals, right? Like I level up and get better because of it, right? If everything was easy, I would, be allowed to keep my skill level the same and it wouldn't affect me. Last year with my eyes closed 109 million in mortgages. This year, if I show up with that same level of effort and attitude, things are going to be drastically worse. I've got to show up twice as good, work twice as hard, which in the end is a good thing because 2024, 25, 26 are going to be amazing years full of opportunity. I mean, next year there's going to be opportunity as well, but it's forcing us all to be great, which is a good thing. One last thing, Google Good by Jocko Willink on YouTube never fails to fire me up. Things go wrong, good. Things are tough, good. That's pretty much what he says. But take me up on that offer. Shoot me a message through social. I'll get you a link to my calendar. We'll talk 15 minutes. I'll inject some energy into you. All right, Flow Rider. Maybe building your own home will be cheaper soon if there's more labor available due to the larger builders slowing down and cost of materials going down. It could be, but keep in mind, like I said, Flow Rider, that it's still going to be capital intensive, meaning a lot of money down. If you want to buy the land, 30 to 40% down is standard on purchasing land. So you got to be, accounting for that. And while there is construction to permanent financing available, I don't know a ton about it because I don't dabble in that space. My guess is they want 20, 30% of that total cost down from you. So you've got some skin in the game. All right. Todd Bazalski, thanks for joining. Appreciate you. I appreciate everybody. Fire off questions, please. This makes for a lot better Q&A. If you guys are queuing, then I can A. You know what I'm saying? Not necessarily about rates, but credit scores. I had 3 charge-offs in July of 16. I paid them off recently. Do those fall off my credit 7 years from the charge-off or when I paid it off? I shouldn't answer this. I don't really know is the honest truth. I'm not a credit expert, but I can tell you, knowing what I know and looking at credit reports, which I'm not in the daily habit of doing anymore. I've got a great team that handles the operation side of things. In the short term, it's probably going to hurt your credit. It's going to scratch that scab and, the blood's going to ooze out of derogatory charge off enough to ding the credit in the short term. I honestly don't know how long it's going to stay on there. There's probably some resources online. Sam Parker at My Credit Guy, they specialize in mortgage stuff. I'm sure they'd give you an answer. Maybe if you ping them on one of their social things, just look up My Credit Guy. Proud partner of Math and Mortgage Guy. All right. Can the licensed general contractors you work with help you get approved for the loan? They can co-sign. This is an interesting question. And this is why I love going live and just answering every single question is you've got somebody who wants to build your house and co-sign for you. I don't know, man. Can the licensed general contractors you work with help you get approved? Do they want to? Do they want to co-sign? Interesting question. I don't know. All right, looking for your DM later, Bradley. We'll wrap, brother. If I buy a deal like Zuber, 200K, 260K, would I be able to get into that investment property without any money down, assuming it appraised for 260? No, the lender's not lending to you based on the appraised value. If you get into a deal and you submit an offer for 200 grand and you're going to put 10% down, You're purchasing at 200 with 10% down, $20,000 down, 180 loan amount. If it appraises at 260, you don't get to capture that like equity in the down payment. It's still basing your down payment off of your purchase price. Shoot me the link for TikTok too. I'd love to see that because, man, if you could do all the stuff that they talk about on TikTok, I don't even know what all is out there, but I know there's some crazy stuff out there, right? Wholesaling and flipping, and you take this, you do that. 99% of real estate transactions and 99% of people that I work with who build a lot of wealth in real estate don't do stuff that's extremely fancy, which is probably the TikTok stuff, right? Sure, you can do seller financing. Sure, you can assume somebody's loan. Sure, you can do subject to. Sure, there's all kinds of stuff that's borderline fancy, but it's still reasonable, right? Like that type of TikTok fantasy and people talking about, that's always the thing too, is like no money down real estate. The people who are watching those videos are being done a huge disservice, right? Like no credit score needed, no down payment. All you got to do is find a seller who's looking to avoid capital gains. So they're going to sell to you with a 1% seller carry and give you a great deal on a fourplex. You'll cash flow from day one. You'll improve your credit. You'll qualify. You'll refinance out of that in 2 years. If it sounds like a bag of goods, it's probably a bag of goods. Housing market is like the weather. Oh, where'd that one go? This was a good one. If you're waiting for the storm, you may never enjoy the sunshine. We need the rain. Enjoy all types of weather. Oh, I need a moderator in here. These free girls in my city. This isn't part of the program. How do I star that? I want to keep that comment. I like this one. Thanks, Jay Homeboy. Enjoy all types of weather. I'm telling you, there are people that are out there storm chasing right now, and they're finding highly motivated sellers, and they're getting great deals. I'm taking a picture of this one. I like it. It's like the weather. You always point me to the bootstrap real estate guy, but he doesn't seem to be active, and his website was broken last time I checked. You want to carry the mantle of being the new subject to mortgage guy? I'm going to hit him up. And you know what I'm going to do? I'm going to have him on. I'm going to text him right now. Ryan. How many Ryans do I have in my phone? There he is, Ryan Nickel. Want to do YouTube live sometime? This guy's the master. I know he's still doing it. He's still active in real estate. I've seen him at real estate meetups and stuff. So Ryan Nickel, bootstrap real estate. I'm going to get him on. As much as I would love to, and I was talking to some real estate agent investor friends today about looking for opportunities and looping me in when they see them and when they hear them. That's something that I think is underrated, right? Having a mortgage pro and a real estate agent who are active real estate investors themselves, they're turning over all the rocks, shaking all the bushes. There's going to be deals that come along where I've got real estate agent partners like, listen, I've got 3 flips going on, and I'm also doing this short-term rent. Like, this is a great deal. It came across my desk. I can't buy it right now. I mean, that's how I bought the 2 fourplexes that me and my wife bought in 2019. Real estate agent said, listen, I've got 9 flips going on. I can't buy this. It's a great deal. You should buy it. I said, come on, Bob. Bob came back and said, listen, Matt, like, it's a great friggin' deal, dude. Like, you should buy this. I'm not trying to buy something in Marysville, hour away. Matt, rents are $3,200. This house, you can get it for $330. Dude's trying to buy a gas station. All right, let's take a look. All right, it's pretty good shape. Buy it for $330. Get $15K in seller credit. It's got 3 1-1s and a 3-2. I think total net rents, 925, somewhere in the neighborhood of $3,900 a month. And that mortgage is $1,700. So I don't know how I got off track here, but connect with real estate agents and lenders who are also investors. They've got their eyes open, and not every single deal that comes across is going to be the deal they want, even if it's a smoking deal. So you might get something handed to you. Not all loans are assumable, unfortunately. Thank you for this comment, Lee. This is a great one, and I want to stress this for everybody. VA loans, FHA loans, government loans in general, you can assume. You can't assume conventional loans. 2020, 2021, 70+% of the loans are written conventional. So a lot of conventional stuff out there right now. On the FHA and VA loans, even if somebody bought it 18 months ago, in most markets where they went up 30%, they might owe $425 and they're trying to sell for $550. You've got to bridge that gap. And you might say, oh, it's a good looking VA loan at 2.875, but can you come up with 120 grand as a down payment? Because if they're selling for 550, you're trying to pay off a $430,000 loan. You got to bridge that gap. So it's one of those, in theory, great. In real life, not necessarily easier said than done, I think is what we want to say. I feel like this camera is getting away from me. It seems so far away. It seems so disconnected from you guys. All right, I'm back. How do you erase these? Oh, put the user in timeout. All right. You come on here talking about free girls in your city, you're going on timeout. We're talking real estate. We're talking about getting rich. We don't got time for free girls in your city, all right? Flo Rida 55. Any recommendations on large companies to look at specialized with construction loans to permanent? Great mortgage broker ever to enter that space in the future? Yeah, I can connect you with somebody at U Mortgage. We definitely have that. We have a leader in our company who came from AFR, who specializes in construction to permanent. I would just connect you directly with that person. And as I've always done in mortgage, if there's something I'm not good at, I want to just preserve reputation and say, work with Sean. He's going to get the loan done for you. You're happy. My reputation stays intact. They close the loan. And so, yeah, it would be through U Mortgage. And this is a great time to interject here too, right? You mentioned great mortgage broker. If you're looking to connect with me and my team, greatmortgagebroker.com, and just fill out that form. We'll be in touch. And when somebody reaches out to you, because it will depend on what state you're in, whether you go Sam, whether you go Jared, whether you go Adam, whether you go Connor, whether you go Michelle, I've got a big team able to handle everybody across all the states. You tell them, listen, I'm looking for construction to permanent. Here's a state I'm looking to do it in. They're going to connect you with the person, right? Whether that's Sean Hammond or somebody else at U Mortgage, we've got the resources. We'd love to help. So fill out the form, greatmortgagebroker.com. I put it in the comments, and we'll look forward to hearing from you. Flo Rida 55. Uh-oh. Sophia Idrissi. Damn. I am sorry that you're in this situation. The good news, Sophia, I'm happy to be your advocate. Send me whatever information you have. team@mtmg.com. 100% guarantee the builder's going to work with you. And whether that's a credit to buy your rate down to 6.25, or whether that's a 2-1 buy down that's funded by them, you know, the seller, the builder, where you've got a 5%, then a 6, then a 7. Whatever the case, my hope and my intuition tells me that they would rather give you 10, 12, 15,000 in credit to help ease the burden of that big jump up in interest rates than have you fall out of contract and have to, sell the house to somebody else. So things to consider, because trust me, I talk to people all day, every day about this scenario. How much is your earnest money deposit, which with most builders is non-refundable? So do you stand to lose 10,000, 15,000, 20,000? If you back out, how much are you going to have to eat? Contractually, you're probably obligated no matter what they failed to do. Second thing to consider is what they're willing to do to keep you in contract and close the deal. My experience tells me that they're willing to play ball. It's a matter of how you negotiate it. And if you're using builder's lender, builder's agent, everybody builder, you got nobody on your side. Good reason to use an outside lender, outside realtor, have people that are on your side. You're in the courtroom and everybody's part of the prosecution. You don't have a defense attorney, just you represent yourself. So anyhow, team@mtmg.com. Shoot me some deets. We'll get you squared away. Fighting for consumers is probably my favorite hobby. How would you handle a client that comes to you and says, I'm buying a $500K home subject to the existing $300K mortgage? Will you loan me the rest of the money with my 5% down? No is the answer. I can't do it. Like, I'm in no position to write a second, which it would be a second behind this first mortgage. And I don't believe you're really going to find any lenders outside of private money that can do this. The only people that can really write a loan like this, which is a standalone second behind somebody's first, is some sort of private money lender that's like got a fund and they're just going to look at deals and analyze them. I can tell you with almost absolute certainty, if you're buying it for 500 and it's worth 500 and the seller's carrying back 3, getting someone to let you borrow 175, meaning you're just putting 5% down on that 500, is very unlikely. There probably isn't much out there in the lending world that's more risky than that, right? I'm in second position. If you default, if something goes wrong, this $300K mortgage gets paid first. There's a ton of fees. There's 14 pennies left over for me, and I'm holding a $175,000 note. Not down with that. So that's why, might sound, unkind or straightforward, but that's the honest truth, is that that's going to be a hard sell. Okay, this is a great question, Sophia, and I'm going to attempt to answer it. Man, not being able to share my screen is a bummer. If you can't hear me, it's no good, right? But I'm going to do some pricing on my side to help explain this. 1 point, when you hear somebody talk about paying a point, is equal to 1% of the loan amount. If you have a $300,000 loan, then that's $3,000. What I don't want you to confuse is thinking that 1 point equals you're going from 7.125 to 6.125. That's up your percentage rate, and that's a totally different thing. So I'm going to guess at some numbers, and I'm just going to call it a $375,000 purchase price and a $300,000 loan. And what I'm going to do is show you, even though I can't pull it up on the screen because it's going to screw up my sound quality, what each point is going to do to your interest rate. Because the first point and the second point aren't the same. There's no hard and fast rule like every point you pay is equal to 25 or like 0.25% in interest rate. I've probably got to do another video on this. I know I did a video on should I pay points. On that video, if you go search Matt the Mortgage Guy, do I pay points? I walk through kind of a similar exercise, but the gist of it is for our example here, you've got a $300,000 loan and your rate, let's call it 6.99 with 0 points. If you said, I'm going to get a point in credit from the builder, they're going to pay $3,000 is what that is for 1 point. That 1 point can buy you down to 6.75%. And so your 6.75%, that saves you about $50 from 6.99. The next point does even better. It takes you down to 6.375. So you originally went from 6.99 to 6.75, about a quarter. The next point actually gets you down to 6.375, which is 0.375%. And that principal and interest payment, $1,871, is actually, $124 cheaper. So if they're willing to pay $6,000, 2 points gets you down to 6.375. The next point gets you to right about 6.125, 6.09 maybe, if we're doing the exact. So you can get to 6.125, $1,822 a month in principal and interest, save you $173 with 3 points or $9,000. So that's how it works. And know that different credit score, different loan to value, different loan product, different purpose, investment versus primary residence is going to be different. It might be that the first point gets you 3/8 and the next point gets you a quarter. The next point only gets you an eighth. The rate sheets vary based on loan to value, credit score, loan type, loan, whether it's an investment or a primary. So all those things factored in, it's always going to be different. But 1 point, the cost is always 1% of the loan amount. Hopefully that made sense. Okay, sale $250,000, mortgage on home for $125,000. How to be creative on this purchase with the least amount of capital. Seller is interested in selling and being creative with it as well. What do you think? If they can do subject to that $125K mortgage and then carry a portion of it back, right? Maybe they say you put $25,000 down, you assume the $125,000 and you pay us payments on the $100,000, meaning, you're financing $225,000, $100,000 to them. And, they're taking on a lot of risk doing it that way, but that's not necessarily your problem, right? Other than that, it's that there's other structures where like you might use a non-QM loan to pay that loan off and put it in your name, and then they carry the second, and they seller carry behind that. I actually walked through an open house this weekend where the seller who owned the house and flipped the house was also a real estate agent and a mortgage broker. And so he had a lease option available for that house where they leased it for 2 years. They put down a certain percent. They made a monthly lease payment. Certain dollar amount went towards the principal. If they executed the lease to own option, then they would pay X price. They would have to use his lending company. It was creative, on that person's behalf. And I think there's some people in this market that would be willing to do that. I wonder if we ever heard back from Ryan Nickel. We didn't. That guy. William Dickerson, my dude. What's up, Mr. Dickerson? Hope you're doing well. Thanks for joining. We got some people on YouTube. We got some people on Facebook. Smash the like button for the YouTube algorithm. Look, you got to smash it for the algorithm, for that guy, right? How do you point to that thing back there? These throw pillows are nice. Take a rest. Can you refinance at a lower rate if you have a mortgage that the house may be underwater? I heard that you can do FHA Streamline if you have an FHA loan. Is that correct? You know what's interesting about this? I'm going to see if I can find this. The CFPB, which is the Consumer Financial Protection Bureau, they do this thing called, God, what do they call it? Where they want information from the public. And so they, like late September, they put out a bulletin that said, give us some information on mortgage products, refinance products that we could create. Specifically, they said, we're requesting information about targeted and streamlined refinance programs that have been used for refinancing, typically with lower transaction costs than traditional refinances. Refinance programs lead to lower monthly payments and lower interest rates for homeowners who previously would have been unlikely or unable to refinance. Innovative refinancing products like automatic refinancing, where it like triggers an offer to refinance automatically, or like automatic forbearance and long-term loss mitigation assistance. I'm telling you that this is something where like they're trying to glance in the future and say, hey, if people have issues, let's have something lined up for them. And if we head into a recession and borrowers have trouble, what can we do to help them? Back in the day, it was HARP, Home Affordable Refinance Program, kind of to your point, where I could refinance someone up to 130% LTV, meaning they could owe 130 grand on a house that was worth 100, and I could refinance them as long as there was benefit to the borrower and they were going to save a few $100 a month. So something might be coming. Hey, Jared, I love it, man. Keep the questions coming for sure. Without the questions, all I'd be seeing is this friggin' Tinder hot adult dating site crap, which put this user in timeout. When you put them in timeout, they only go for 5 minutes. And then you got to, I should permanently block them, right? Unless you guys are into that stuff. Back to your question, Jared, which I appreciate. Would you fund a house worth $500K if the seller agreed to carry 200 of it in second position? Is that a thing? When you come to Matt the Mortgage Guy or You Mortgage, greatmortgagebroker.com, it's not my personal decision, right? Where I'm like, you know what? For Jared, let me do this, which you probably already know. But I think your question is basically like, would a lender do this? And the answer is yes. It's not going to be a conventional lender. It's going to be someone who plays in creative financing, non-QM type space. So it's going to be at a higher rate. And so you can get that 300 grand. It might be 9%. And so if you're going to do that, I think you offset it by getting the seller to give you a smoking deal on that 200, right? I literally talked to somebody earlier today who got a seller to do 2% interest only on a seller carry. If you can get an owner to do 2% interest only, you're winning, right? Even if your first is 9, that blended rate is going to be sweet. So yeah, it's possible. It's possible. I literally just looked at the clock for the first time. We've gone an hour. I got work to do, folks. I really appreciate everyone who joined. I think that maybe I should start calling this office hours. I really want it to be interactive Q&A. When I get on here and say, here's what I'm seeing, here's what I'm feeling, here's what's going on, that's 5 or 10 minutes. The rest of the time, I think it's really productive to do Q&A. Come with questions, come with, here's a scenario I'm looking at. What do you think about this? What are the pros and cons of a 2-1 buy down? What do you feel about, a seller who's been on the market for 59 days? How do I approach putting in those offers? I can give you real life advice from real life scenarios, because all day, every day, that's all we're doing is we're finding great deals for investors. And when I say we, it's a real estate agent, us just structuring the loan, and then I'll give my 2 cents to buyers who ask, because I'm an active investor and somebody who's playing in the space every day. Yeah, bring the questions. I'll be back on next Monday. Because of the special request, I am going to see if I can get Ryan Nickel bootstrap REI. If not, it might be just me, but let me know who else you guys want to see. I'll invite some guests on. I think that's fun. It's more fun for me, and then banging out some Q&A. SoCal Adventures. Reason I was asking is, if you buy a house now and you end up maybe 10% underwater, how can you lower interest rate when they gonna go down? I guess that would depend. Yeah, if you depending on how much you put down, right? If you put down 20%, then went down 10, there'd be a delta where you might refinance, and now you got mortgage insurance, where you have to weigh the pros and the cons of, I went from 80% LTV to 90% LTV. My rate and term refinance has a new rate of 4.25, but I've got $58 in mortgage insurance. Is that better than my current 6.5? Those are the type of things, but this SoCal would be those streamline options, which, truth be told, there's not anything existing right now on the conventional side. On FHA, there's FHA Streamline, and VA's got the VA IRRRL. Conventional, there's no HARP program existing. But if we get in a position where that becomes a thing, I don't see a huge turn where it's going to be a lot of folks that are in serious underwater positions. But if there was, programs would come available. I would think so. Todd Bazowski, if I have 20% down, is it better to do conventional FHA with a lower rate, knowing I'll have PMI? For sure, you want to do conventional. The thing you want to look at is, if you got a 660 credit score, then your mortgage insurance is going to be relatively high if you do lower down payment with conventional. But if you're doing 20% down, it's all day, every day conventional for sure, because the spread in interest rate is probably like low 6 versus high 6. And while, that looks good with the mortgage insurance of $300 or whatever it is on the FHA, it's going to be more expensive. Also, FHA comes with upfront mortgage insurance. So 20% down scenario, it's almost always conventional. I'd love to do, comparison FHA versus conventional when we have more time, maybe next week, maybe on a video, but there's pros and cons to both. If you're putting 3.5% down and you've got, credit that's sub 700, FHA might look better side by side, but really you got to do it. There's so many different variables and so many different scenarios that you got to put them side by side to realize which one's better for you. All right, last question. Jared Haxton, reputable places to get non-QM mortgages. We do them. There's 30-year loans. There's 40-year IOs. There's all kinds of stuff. I know exactly where you want to go, and it is greatmortgagebroker.com. Debt service coverage ratio loans, bank statement loans. We send our non-QM stuff to Home Express, to Remen, to Angel Oak. There's 5 or 6 players that really do non-QM well, and there's a bunch of people that are pretending to do it, that are going to fumble F it the whole way to the finish line, and you'll probably pull your hair out and want to quit before you get to the finish line. But anyhow, greatmortgagebroker.com. Reach out. We're more than happy to help. We got a great team across the country. Greatmortgagebroker.com. Check us out. Until next time, guys, we gonna see. Oh, look at Ryan Nickel. He's in, guys. Would love to. So we'll set that up, right? Bootstrap REI. He's in. Later, guys.